For more on how Groupon's marketing cutbacks may impact its business and its plans to go public, we turn to San Diego and Paul Kedrosky, Bloomberg contributor and editor of the blog Infectious Greed. Paul, welcome back to Bloomberg West. Groupon on its fourth IPO filing now. Is this promise of marketing cutbacks, is that going to work?
Oh, absolutely. I think the problems are solved. It's all good now. No, I'm just kidding. No, I think it's I think it's more of the same. And I think in particular what they've done for themselves, and Cory kind of alluded to this earlier, is they created an expectation that they had to live with. And one was that they were going to see marketing expenditures decline as a percentage of sales over time. And in particular, they tried to push that idea by creating this unorthodox, measure of profitability that tried to exclude much of their marketing costs from the bottom line. And so now what they're really doing is they're trying to live up to that bet and say, hey, look, we can actually, when we were just saying those things, we're actually going to cut marketing spend just the way we said we were. And I think it's very clear from the company's numbers that should they follow through and do exactly the things that they're describing, that I think you will see a significant deterioration in their business. So I see this as a kind of bluff with the market and say, you're asking for these things, we're going to do them. Now can we please come public?
Paul, how unusual is it to see this many filings before an IPO? Is it unusual?
Yeah, it is unusual. I mean, it tends to be sort of bimodal. You see people who come out with literally, almost a clean document, one revision max, and at the other end, you tend to see these sort of serial revisers. I think the most I ever saw was something like 12 or 13 back a few years ago, but it tends to be one end or the other. These people who are almost having a conversation with the market, saying, "Hey, will you take this? Well, what about if I do this? How about if I change it this way?" And that's usually a reflection of investor nervousness and saying, let's just keep changing the story and see what it is we can sell to get out there. And this, obviously, Groupon is deep in the serial revision camp here.
Paul, what do you make of the fact that some things are changing, some things aren't, in regard to their expectations of spending on marketing? I mean, we mentioned they expect to significantly cut it, but they also pulled that sentence saying that marketing would decrease as a percentage of revenues.
Yeah, they did. I mean, I guess you could counter and say that, well, look, now they don't have to promise it anymore. They actually look like they're going to try and do it, which is, maybe a charitable way of interpreting, the change in filing. But I think it's also, they just want to lower the awareness of that whole side of things. They changed the way they account for profits on marketing-related expenses as they drive profits. They're changing the way that they talk about the structure of the business. And they're hoping people, I think, will just not worry their pretty little heads about this whole side of the business and instead focus on, here it is, here's all the things you asked for, and here's a reduction in marketing spend, and again, can we now please go public? And I think, judging from the appetite I hear from institutional investors, really nothing has changed. The people who are most eager to see Groupon go public are almost uniformly institutional short sellers who say to me constantly, I wish you'd shut up about this company because I desperately want them to go public so I can short them.
I can't tell you how many of my short seller friends have said the same thing to me. It cracks me up. But so some of the math I've been doing on this is about the difference between subscribers and customers. And subscribers is essentially emails that they have or email addresses that they have. They call them subscribers. And customers are people who actually use a Groupon offering. What metric do you think is important when you're trying to understand how this business works or isn't working?
So, I mean, the first one obviously is, the cost of customer acquisition, which is the cost of obtaining a quote subscriber, which is really just an email address. Subscriber is a bit of a misnomer because it doesn't imply any real, transactional relationship. They're not spending anything. You just have their email address. So that's one, and that's a worrisome figure because it's actually going up into the right, the cost. The second is, the conversion rate, the percentage of subscribers that you can convert into actual paying customers. And there is no sign that that's actually improving at Groupon. As a matter of fact, most of the data I've seen suggests that it's actually tapering off, that not only are fewer people turning from subscribers into paying customers, but previous paying customers are actually seeing high levels of attrition. So those two secondary numbers, I think, are at least, if not more important, and both of them are moving in the wrong direction.
Paul, how do you think this is ultimately going to affect the IPO? Do you think there's going to be more delays? How long will it be delayed? Do you think bankruptcy is a possibility here?
I think bankruptcy is a possibility. I mean, I think there's enough people who are willing to put up money to finance whatever negative working capital this company might have, or even should they cut marketing low enough that they don't have negative working capital. So that can all work. It's just a question of when the market's receptive enough to let this kind of thing come public, because it's a very unusual deal. It's not really a tech deal. It's a services deal, and it's gone through this fluid relationship. So my guess is it's entirely driven by the IPO window at this point. Should we all of a sudden, risk comes back on in the market, this thing will be at the market's doorstep before the doorbell goes ding.
Paul, Sony shares have plummeted nearly 42% over the last year. Would buying Ericsson help Sony in this case?
It's hard to see how it would hurt. The fundamental problem Sony has, and I think they're reasonably upfront about it, weirdly enough, in the Wall Street Journal story, that the company fundamentally missed the ball badly on the smartphone marketplace and tried to get into it through this joint venture with Ericsson, a joint venture that really hasn't worked out very well for either side, hasn't been something they can leverage into anything they can do for their existing products, hasn't driven laptop sales. So it's kind of the anti-Apple, if you want to look at it that way. They've got all the same pieces, but none of them work. And they don't work for Sony, and they don't work for, to drive the business. So it's the right thing for them to do. Their non-presence, I guess, in the smartphone marketplace is hurting them in everything else they do, and is one of the things causing the decline in their market capitalization. But the problem I have is that it's almost certainly too little. Maybe not too late, but it's too little. It's not going to get them there.
Paul, I know you have your theory, the Apple Death Star, referring to the companies that Apple is killing. I mean, why is Sony missing the ball so badly? What's the problem there?
Well, a bunch of things. One is that their products really aren't integrated together at all. So owning a Sony, there's no particular reason why you need to own a Sony TV and/or a Sony DVD and/or a Sony audio unit, a mobile unit, the old Walkmans, or a Sony gaming system or a Sony phone. There's no integration across all of these. It's not as if owning one says, you know what, I got to carpet bomb my house with every single Sony product because they all work together so wonderfully. What you have instead are a bunch of point products, most of which are also RANs in their own categories. It's not the best televisions. It's not the best portable audio devices. It's not the best laptops. And God help you, it's certainly not the best mobile phones. So as a result, the company is losing ground straight up in each of these niches. And then at the same time, they're losing against companies like Apple that have an integrated story to tell. And once you buy one piece of that story, you end up, as I say, literally carpet bombing your house with all these pieces. And Sony suffers badly by that comparison.
Paul, do you think this suggests they're actually going to go stronger into the phone area and away from TVs? I mean, as bad as phones have been for them, it was profitable last year. The TV business, from my reading of, I don't read Japanese, but the translations of the annual reports suggests that the television business is really what's been killing them. They haven't turned a profit in TVs, I think, in a decade.
Yeah, more than a decade, I think. But yeah, you're right. The TV business is what's killing them, and they're hoping that by actually having, a clear position in smartphones, and to be fair, it's Android phones is where they want to be, and actually, telling a good story there, that'll become a halo, as the tech kids like to say, and that halo will continue growing and drive sales in laptops and all of the other products that are much more profitable for them. And the trouble they have is, it's in a sense the trouble that RIM had, is that they're so late to the game, it's very difficult to see how they iterate their way to market dominance or even a reasonable position in the market years after everyone else has established a position either at the commodity end of the market or at the premium end of the market, whether it's Android or I suppose iOS. But nevertheless, that's the strategy. They want the Apple Halo strategy. I just don't think this late in the game it's doable. I don't think it's a doable strategy for them anymore.
But is it really late in the game? I mean, if Research in Motion has gone from hero to GOAT in about 3 years' time, doesn't it suggest this market is so much more dynamic that someone could come in with a great product that's greater than the last product and it might be a new player?
Yeah, absolutely, but it would be someone who's focused on smartphones, like I suppose a Samsung, I guess, or someone like that, or maybe or maybe a resurgent Nokia or someone like that, but not someone whose attention is scattered across so many different products. I just don't see how they've got sort of the coherency and crispness of their vision about smartphones to drive them, back to dominance in that marketplace. And they concede that, it's conceded themselves that even if they were to work this out, it's probably 1.5 to 2 years until you see a next generation of products from them. 1.5 to 2 years in this marketplace is truly forever. And and you see that reflected in the valuation of the company, where last I looked, I think the market capitalization is only maybe 10% below, or sorry, the other way around, cash on hand only slightly below market capitalization. This thing isn't trading much above cash.
Paul, of course, Steve Jobs passed away earlier this week. Do you think that's going to slow Apple down at all? How far ahead is Apple of all these other competitors, and are they going to be able to catch up?
Well, I mean, certainly not. I don't see Sony as the real threat here. Insofar as there's a threat in the sort of the post-Steve Jobs era at Apple, it's probably a company like Google, or even, I suppose, some outliers like Nokia or Samsung or someone like that. But you know, I guess the Apple story really, if nothing else, really hasn't changed and arguably gets stronger. There's stories floating around today about how, you know, in those last few weeks and months, that Jobs had really put together a pretty crisp story in terms of what he thinks the company needs to do over the next 2 or 3 years. So you do have the invisible hand of Steve Jobs continuing to guide the company, and I think that's something that stands Apple in awfully good stead against a number of very, very confused competitors like Sony.
Indeed, they have been preparing there for the last 10 years. All right, Bloomberg contributor Paul Kedrosky, thanks for joining us here on Bloomberg West.